2022 has been a mixed bag for investors. We saw a lot of money lost in the Wall Street casino. We saw cash pouring into multifamily apartments. And we saw many people rethink how would they approach their wealth creation.
And like most people, maybe you couldn't help but ask yourself these two important questions. How bad is it going to get? And what can I do about it? Hi, I'm Palmy.
And I'm Nancy. Together we make the Kitti Sisters, your financial BFF and your apartment investing go-to source. The reality is that inflation is still at a 40-year high and interest rates are trending in certain directions, which obviously affect the affordability of real estate across the board.
The cold, hard truth is that we will always share with you that inflation has actually been helping the rich people get richer by creating a divide, a wealth separator. Those with hard assets have experienced tremendous appreciation and have seen their portfolios grow.
I totally agree with you, Palm. If you're here tuning into us right now, then we can safely assume that you love real estate. But to be honest, real estate will never be the same again.
Now, as we close out this topsy-turvy year, let's bust out the obituary on 4 apartment trends that died in 2022. Please like, subscribe, and hit that bell icon.
Let's get into it. The first trend that died in 2022 is bridge loan.
Let's take a step back and talk about what those are and where they came from. Bridge loans really entered the scene in a big way in early 2020 at the start of the COVID-19 pandemic. Freddie Mac and Fannie Mae, two quasi-government agencies that were the largest lenders in multifamily apartments, sort of had a PTSD moment. Essentially, they froze up and stopped lending based on their previously prescribed underwriting criteria.
Having dropped off the face of the planet, loan-wise, a lot of private equity firms step in to fill the void. This ushered in the age of bridge loans.
Let's first take a look at what bridge loans are and why we say it died in 2022. Essentially, commercial bridge loans provide short-term financing for those who otherwise wouldn't qualify for these additional loans for their multifamily apartment purchases. They are different from your standard type of financing because they're based on the debt coverage ratio or service to loan ratio rather than the ratio between loan to value.
Bridge loans are typically structured as a 3-year loan with the option to extend the loan an additional year twice, right? In other words, the 3-1-1 structure. Experienced general partners love bridge loan because bridge loans provide tremendous flexibility upon exits since they don't have any yield maintenance or prepayment penalty tied to early exit of the loan upon a property sale.
Yeah, and lenders who are on these loans are also a little bit more flexible in their underwriting because they can rely on the stabilized income versus the loan agencies that are focusing more on going in income. This translates to loan proceeds that are going to be higher and also lower interest rate upon entry of the loan as well.
That's true, Palm. But keep in mind that with this flexibility comes some volatility as bridge loans do not have a fixed interest rate. It's a floating rate, right, Palm? And that is tied typically to an index like the SOFR 30 days average.
At the beginning of the pandemic, for example, a borrower will probably be paying around 3.1 to 3.5% of interest on interest-only payments, which makes the cash position for an apartment investment juiced up.
The problem lies in the volatility of the underlying index.
As inflation has risen, the Fed finally woke up to the fact that it's really not transitory and the fund rate hikes have caused the underlying index to skyrocket.
For some loans, this amount has literally jumped from 3.5 to 4, 5, 6% depending on their rate cap, which is too detailed for us to go into it right now.
For real, if someone today is crazy enough to get a bridge loan, they're gonna probably see quotes with interest rates as high as 7.5 or even more. This also comes with requirements to purchase rate cap insurance, which has really cost 10 times as much as it did last year. In fact, rate cap, which cost maybe $200,000 12 months ago, today, it's gonna cost you at least $2 million, and that will totally tank the cash flow of most of the deals.
So this is why the bridge loans trend has died in 2022. So now you may be wondering, well, if bridge loans has died, what's in?
You don't have to take a trip to Paris to know that fixed rate loans are now in vogue again, especially with the subset called loan assumptions. What are loan assumptions? Loan assumptions simply allows the buyer to access the same low fixed rate that the buyer was able to lock in before the shiz hit the fan in 2022 and interest rates soar. It's kind of like Dumbledore's time turner that allowed him to jump back in time. In case of loans, jump back to pre-2022 when interests were at the all-time lows.
In volatile times, the most ideal scenario is for the buyer to be able to assume the seller's fixed debt because this de-risks the investment.
The major risk in real estate is short-term floating debt with no rate cap, which as it increases can severely impact the cash position of the property, potentially requiring capital costs to stay afloat. So, low interest fixed debt de-risks the investment by eliminating the risk of increasing mortgage payments. This means that as long as the asset is income producing, there's virtually zero risk of default. And we all know that real estate is a hard asset that is in the right market will always increase in value in the long run.
Honestly, one of the trends that we never would have predicted would die in 2022 is the starter home ownership. While we knew that the US is turning into the nation of renters, we also all witnessed homes being snatched up in the record time for the last several years.
This bumps us out, but it died in 2022 because simply put, interest rate hikes made it essentially unaffordable for people to buy their starter homes. This situation is even more dire in gateway cities such as New York, Chicago, San Francisco, Los Angeles, where starter home price starts around $1 million on reasonably desirable neighborhoods.
As new household formations takes place, instead of purchasing their starter homes, these young people will have no choice but to rent and maybe even become lifelong renters.
This is a terrible position for them, but as apartment investors, this represents a major boom because we know for 100% certainty that the product that we produce, apartment units, will continue to be in high demand for the foreseeable future.
Even crazier than that, according to research done by Urban Institute, home ownership growth will weakening over the next couple of decades, following for almost every age group, essentially creating a nation of renters. While this isn't great news for the housing market, it means that apartment investing will continue to grow, which we love, right? Am I right?
Yeah, and if that's not enough, according to the National Multifamily Housing Council, over the next 10 to 15 years or so, the US will need to be building additional 4.3 million apartments in order to keep with the rising demand. In simple economic terms, these two colliding forces will continue to push rent higher and higher.
The Kitti sisters continue to see strong rental rate growth in all the property under our portfolio, right? So for example, one of our apartment complexes in Atlanta, a 244 unit, which we own since last November 2021, has seen a 22% increase in rent and renewals.
We swear, we don't hate trends, but well, maybe bell bottoms coming back. But next trend that died in 2022 is the seller's market. For the past 5 or 6 years or so, we kept hearing it's so hard to break into apartment investing and that the property prices are through the roof. And it's been true, apartment values have never been higher.
With that, the sellers were emboldened and definitely took advantage and set really aggressive terms to their benefits because, they had a line of buyers, people looking to buy their apartments. Some of the terms were such as, non-refundable earnest deposit within 3 days of the purchase and sales agreement signing, contract with zero contingency, etc. Right?
So obviously, you don't need a degree from MIT to know that these terms are, of course, extremely favorable for the sellers, but it also transfers all the transactional risk to the buyers. If the buyers can't close on the property, even if it wasn't their fault, i.e. the seller cooked the books and basically made up their financials, basically the buyers have zero recourse to try to recoup that earnest deposit money. And for deals that the Kitti sisters buy, we're talking about 7 figures or so. By the way, this doesn't even include the legal, due diligence, or loan application fees that can total in the 6 figures range that can't be recouped as well.
Keep in mind that with the seller's market also comes with the expectation that the offers submitted to seller must be at or above the whisper price, right? Well, most apartments that are listed in hot and desirable markets typically do not get listed with a price. Instead, the broker will typically provide a whisper price, which is typically the lowest price a seller will be willing to offload their asset for.
This might have worked when, it was a seller's market and the sellers see people lining up with offers well above the whisper price. But guys, that's not the case anymore. There are a few constraints that those buyers need to consider now. One of those is availability of capital.
Let's face it, a lot of lenders expect a slowdown in the economy. They have either shut down completely or have become more conservative with their underwriting on what type of asset and at which leverage or loan to cost, right? They are willing to lend. Offering in pie in the sky pricing and then hoping a lender will buy in probably won't work in today's market. The other constraint is realistic passive investor returns. Because general partners can no longer rely on the hot markets to boost their passive investors' return, they need to be more conservative with their underwriting and make sure that they don't overpay for an asset.
But all good things must come to an end. So we say goodbye to the seller's market and we usher in a new market for the buyer's reality. This reality consists of refundable earnest deposits with contingencies built in to the offer, such as loan contingency, etc. We also see opportunities to purchase properties at a steep discount where the sellers may need to exit due to their short-term floating interest rate coming due. In our recent experience, we've seen even an 8-figure discount. At that point, they're willing to take a haircut in order to make sure that they preserve their investors' capital.
The last trend that we are saying sayonara to in 2022 is break-even or negative exit cap rate.
Before we dive deeper into this trend, let's start from the beginning. As we all know, an apartment's value is derived from the income it produces. The simple formula used is value equals net operating income divided by cap rate. The lower the cap rate, the higher the value.
For example, if the property NOI is $100,000 and the cap rate is 5%, the property value is $2 million. If you drop the cap rate to 4%, the property value is now $2.5 million. In the value formula, the hardest thing to predict is the cap rate on the exit. This is because it's a forward prediction that no one really can predict and foresee.
That's so true, Nan. Think about it. Back in 2019, did you see a pandemic coming? And then supply chain constraints? And then inflation, interest rate hikes? No, right? And that's why conservative general partners tend to use exit cap rates that are higher than the entry cap rate, at least 50 to 100 basis points higher.
This is done so that the projected returns account for potential slowdown in the economy, which is something we absolutely do to stay conservative. For example, we may have an entry cap rate of 3.5% and an exit cap rate of 4.5%.
No surprise, not everyone follows this example. In fact, we know many big shots, well-known general partner teams that use either a flat exit cap or even a negative exit cap in order to make their returns enticing for their passive investors. Well, this trend certainly met its maker in 2022. If you see any deals with flat or exit cap, you know that the zombies are right behind, so definitely run as far away as you can.
So there you go. These are the 4 apartment investing trends that died in 2022. While it's too early to tell with certainty, we don't expect these trends to be back anytime soon.
If you believe that real estate will continue to grow with inflation and real estate value will rise over time, the more wealth you build, the less tax you pay, then investing in real estate is still the way to go. All you need to do is know how to identify the new trends that could create huge market opportunities like the ones that you see that will grow your wealth over the next few years.
So that's it from us today, guys. Thank you so much for tuning in today. Make sure to join the Kitti Freedom Club for even more investing tidbits. Until next time, cash flow multipliers.
And of course, don't forget to click like, subscribe, and hit that bell icon so you don't miss any of our videos.